Hello, my name is Levio. If you own a discount brokerage account, have a 401k plan, superannuation, or other retirement plan anywhere in the world, then this information is for you, and it can cut your time to retirement substantially. If you own mutual funds, stocks, gold, silver, currency, or real estate, then you are in the right place at the right time. Whether you are a complete novice investor, have little money, or have experience, or are an investment professional, this short video is going to teach you how to change your financial destiny for the better. Do you know there's a proven way to make money while the markets are going up? Yes. And there's a way to make it 50%, 100%, or 200% or faster, and do it without risky options or futures contracts. That's right. Would you like to know a proven way to avoid the majority of market declines or even make money while they decline? Nope. You don't need risky options or future contracts for this either. That's right. Let's get right into it so that you could take a deep breath, relax, and not worry ever again what the markets are doing or are going to do. You'll have complete control and peace of mind knowing your family's well-being is protected from the insecurity and devastation of substantial stock market losses. So let's start right now. Let's go.
At InterAnalyst, our track record proves this. The stock market's direction does not matter. What you own during that direction does matter. Lower your fund fees, build profits while markets rise, preserve those profits while markets decline, and retire up to 21 years sooner. The chart you see in front of you is that of the S&P 500. The S&P 500 is the benchmark index for the overall U.S. stock market. The S&P 500 index is what financial analysts use for correlation analysis. Correlation measures how investments move in relation to each other. -1 means investments move in opposite direction. As you can see there, one's going up and the other's going down. +1 means investments move in similar direction. As you can see, the two are going up and the two are going down. High positive or high negative correlation is the key to limiting risk and increasing return in both bull and bear markets. Okay, so let's learn about positive correlation. We use the S&P 500, as everybody does in the industry, to visually show you correlation. The bold black line in the 2008 chart below is the S&P 500 index. The other colors represent the Dow Jones Industrial Average, the Russell 2000, and the NASDAQ index. As you can see during the crash, all of them went down in lockstep with the S&P 500. This needs to bring up something to your mind real quick and ask yourself, well, if they all go down, what does diversification mean? You see, it's not just about diversification because as you can see here, diversification, they all went down. So it's not just about diversification. It is about correlation, and we're getting there slowly as we go forward. Okay, now that we're done looking at a bear market, let's look at the bull market that you see in the chart here. That's since 2009. What does this positive correlation imply? It implies that large cap, mid cap, small cap, international, and technology indexes all move in lockstep with the S&P 500 direction and have a correlation of close to +1. Okay? You can see the little box there with the symbols in it. The first one is SPY. The second one is the Dow Jones Industrial Average, DIA. The third one is the Russell 2000, the IWM. And the QQQ represents the NASDAQ. If you take a look at those, they are all above 90%. What does this imply? It implies, as the two charts illustrate, that the markets go the same direction, or these indexes go the same direction as the S&P 500. Okay? So if there's going to be a bull market, they'll follow. If there's going to be a bear market, they're going to follow the S&P 500. Okay? That's what this implies. Now let's take a look at negative correlation. The chart below implies that SH has a correlation of close to -1, because as the S&P 500 moves, SH will move in lockstep in the opposite direction. This is better known as an inverse fund, because as you can see in the chart, it grows when the S&P 500 crashes. Okay, you now understand, okay, that there is positive correlation and negative correlation, okay? What we're going to do is teach you right now the wealth preserver and the arrows that provide the direction of the market, okay? And then when we come back from that, we'll show you how to profit from both positive and negative correlation. Now that you understand how correlation works, let's take a look at the Wealth Preserver subscription. Arrows are only confirmed and locked in the last trading day of each month. When you see a green up arrow, like this one, buy and continue to buy within your brokerage or retirement plan account until you see a red arrow appear. When a red arrow does appear, it indicates to sell your investments and avoid much of a serious decline in your retirement account. When you do sell under the red arrow, your money will automatically settle into a money market account within your retirement plan or discount brokerage account. Note, not every arrow is perfect, but wouldn't you rather be safe than sorry, like most people in 2008? Because the red arrow locks in the high growth you captured under the prior green arrow. Then all you do is wait for the next green arrow. That's all there is to it. Green arrows mean invest, red arrows mean preserve and protect. Okay, now that you see how accurate and how great these arrows are, you can learn now how to make your money grow faster in bull markets. And it's done through correlation. If you look at the little chart there with the SPY, the RYNVX, and the RYTNX, it represents three securities that are based on the growth of the S&P 500. The SPY obviously is 1-to-1. The RYNVX is the RIDEX Nova Fund, and it grows 150% faster than the S&P 500. Then there's the RYTNX, okay? That fund grows at 2 times that growth of the S&P 500. If you know at a better than 90% clip that your correlation is going to take those assets up, why grow at 1-to-1 when you can grow at 1.5-to-1 or 2-to-1? Does that make sense? Now you see how correlation works. Well, let's take a look at the growth chart, okay? As you can see, since 2009, okay, in the the black, you can see that the market grew 128%. Now, if you use the RYNVX at 150% growth rate, you would have grown at 257%, okay? With the same exact movement of the S&P 500, all right? Now, let's take a look at the 200% growth rate. The RYTNX, instead of getting 128 or 257% growth, you got 358% growth, all in the same time frame. So now you can see how you can put correlation in your pocket, in your retirement account, and get to retirement way faster. Now, let's talk about bear markets, okay, and the risk associated. Here's a question you can answer. Is it lower risk to lose money when the market declines with buy and hold, or to preserve your money by exiting and sitting on the sideline? You can see in the chart here, had you got out with our arrow, you'd have been sitting up here with 0% growth. If you'd have held on, you'd have ended up negative 40, 50%. That's in 2008, and look at the correlation. So you can see that diversification wouldn't have helped you. The only type of thing that would have helped you is getting out, okay? Since you know that if you lose 50%, it takes 100% just to get back to even, okay? So here's one way. You just simply sit on the sidelines with our red arrows. We are going to have fun here on this slide. This is a bear market question, number 2, and I want you to think very closely and stay focused on this because this is just stunning. Is it lower risk to lose money while the markets decline with buy and hold, or to make money because of very high negative correlation? You can make money while everyone else loses. Let me show you. This little box here shows you the SPY, which again is the S&P, as you know. And then it shows you SH. SH is an ETF that is the inverse ETF of the S&P 500. Now I want you to understand, this is not a high-risk options or puts. It's not leveraged or anything like that. It simply works like a regular mutual fund. The only difference is instead of making $1 while the market goes up, it makes $1 while the market goes down, okay? So let's look at the chart. As you can see here, if you'd have had $100 at the beginning, at the end, you would have had 50 if you just bought and held. Or had you bought the short SH, okay, which is the ETF, you'd have ended up with $174. So while you have 174, your friends have 50. Amazing. So in other words, not only like in the previous slide where you can make money while the market's going up at either 100, 150, or 200% going up, you can also make money when it's going down. This gets you to retirement so much faster, it's stunning. The Wealth Preserver works in 401k, IRA, superannuations, and other retirement plans around the world, okay? Here's how it works for those. Since you've learned that correlation analysis proves that better than 90% chance that the assets within your retirement plan are going to go up and down with the S&P 500, why in the world, when we get a red arrow, would you want to be in that and in those assets within your retirement plan and see them lose up to 50% or even more with the coming crash? Makes no sense, okay? Just sit on the sideline, contact your plan administrator, and request that they just put it into a money market account or the safest government bond fund and sit on the sideline while that declines. Then get back in, as we showed you just a few minutes ago in those charts. Now, for those of you who do own discount brokerage accounts, or if you don't have one, I suggest setting one up, okay? The nice thing about the discount brokerage account is that within that account, you can get the SH fund, okay? You can also get those 150 and 200% leveraged assets going up. So you can really put your retirement into hyperdrive. With retirement plans, you can avoid the declines and grow at a normal pace. With the discount brokerage accounts, you can grow at a much, much faster pace, okay? Because you can make money when the market goes up and you can make money when the market goes down. Those short funds are not available in retirement plans, okay? So at least you don't lose 50% in the retirement plan. You can at least preserve that and grow at normal market rates on the way up. You're still miles ahead of those people who don't avoid bear markets, okay? That is how the Wealth Preserver can help you.